So today's fund analysis is about SBI ESG Exclusionary Strategy Fund. So this came into being from 1st January 1991. So it's over 34 years. The present fund manager is Rohit Shimpi. He has been managing this from Jan 2021. Uh, the strategy is to create wealth by investing in companies which are ESG compliant. So again, here they are saying it's a long-term wealth generator. So usually you have to invest at least for 5 years. The exit load is 1% if you are liquidating before 1 year. So ideally, any equity investments, ideally it has to be over 5 years. For somebody with that time horizon, exit load doesn't matter. The benchmark they have taken is Nifty 100 ESG, right? And the current AUM is over 5,000 crores. These are the expense ratios if you are investing directly through your Demat account or through Zerodha or Grow or any other platform, it will be 1.44%. But if you are investing through a distributor, it will be 1.95%. And if you are going to a financial advisor, probably he or she will add 0.5% or 1% depending on the fee you accept with them. Right. So let's go to the analysis. How this fund has done against the various indices. So basically, as a obviously the fund manager will be has to give one index and has to compare with it. But as an investor, your opportunity cost can be any other index. So what we have done is we have looked at the rolling returns on a minimum return, maximum, median, and mean return basis, and number of negative instances which have been there from 2013 to present date. Google Finance has data only from 2013 January, so the analysis we have done it from that date only, right? So here, if you look at it, the fund has outperformed the index across the time horizons, and even the negative instances are very low compared to the different indices. So if you look at the regular index, SBI ESG fund regular compared to the direct one, so you will see the performance difference would be around 0.6, 0.5%. Same thing which is there here, right? They have been charging around 0.5% more. So that performance differential is always there, right? That's what happens when you are investing in a regular fund. But again, if a distributor is suggesting that, hopefully he'll be doing you asset allocation, goal planning, and he's recommending for a purpose, he's understanding your goals and everything. For that, you are basically paying out. So if it is 1% that you are paying, obviously this will go down by another 0.5%. So when we are comparing with the Nifty 10 ESG fund, so it makes more sense if you are looking data for 5, 7, and 10 years. So over 5, 7, and 10 years, the outperformance is there, but it's not huge. Say, for example, if you look at 11.19% in direct, so that is 10.45% in regular. If you are if your fee is being charged at 1%, probably you will be getting around 10.19%. That would be less than the index they are comparing with. So if you are comparing the other indices, so it is Sensex, Nifty 50, or Nifty 100, or Nifty 500. Again, there is not too much of a difference which is there. So when you are actually going for an active fund over a 10-year horizon, it has generated around 1.5% of additional alpha. That's not very high, right? So for Nifty 500, this has been even low, right? Nifty 500 has outperformed the regular fund which is there. Say, for example, it makes more sense if you are if you are a do it yourself investor compared to a distributor or a financial advisor, you will be better off investing in Nifty 500 if you look at the returns which they are giving, provided you are able to do all the asset allocation, goal planning, and what all is required. So how, but is this the only criteria we have to look at when evaluating the fund? No. Actually, if this fund is doing better during the downturns, probably this fund will be, you will be better off investing in this fund compared to the index. So let's just look at the different data points from 2013 to 2017, which is 5 years, and 2008 to present, and since the inception. How has it moved across along with the index? So we have taken the same indices and direct and regular as well. So this is from 2013 to 2017. If you look at it, it has pretty much mimicked the index. Only there were few companies which were excluded here, right? So that exclusion has resulted in this additional return. So if you look at the regular part, regular obviously will be following the direct only. So, but Nifty 100 ESG has done less than Nifty 500. So, see, overall, this Nifty 500 and this one has been meeting. So, here the gap has been higher compared to Nifty 500 because of the exclusion. So, but here by the time you have come, so whatever they have excluded, probably it has performed well. Right? That's the reason why Nifty 500 is at 198 compared to this one at 206. So this is something we have indexed to 100 and we have done it. So on a 5-year time basis, there isn't too much of a difference. But if someone is choosing this one, again, you have to deal with the key man risk as well, right? So, and this performance is not that of the present fund manager. It has been that of because this present fund manager is there from 2021 onwards. So again, this is an SBI AMC fund, so it is pretty much institutionalized. The key man risk will be low comparative to any other niche smaller fund houses. But again, this is the performance is just tracking the index, right? In this case, it is Nifty 500. Let's look at from 2018 to today. So from 2000 to 18 to today, again, this has been like really pretty much close. So if you look at the direct fund, it is at 245. So the blue line here would be Nifty 100. So the Nifty 100 has done the least, that is at 211, and this one is at 245, right? So over from 2018 to present day, it is like over 7 years time. The alpha generated is close to, in the absolute terms, it is close to 20% when compared to Nifty 100. So, but if you look at the Nifty 500, right? So the difference is not much again, 223 and 245. And again, it is moving in the same direction. Whenever the index is going on, this is going down. So it is not neither giving you a downside protection, nor is it giving you an excessive upside as well. So it is just tracking the index, if I'm not wrong. And let's just look at the chart from 2013 to today, so that if there is any kind of difference. So if you look at it, it's an exactly same proper tracking is what they are doing, apart from excluding the funds. Probably that's the strategy they intend to follow through this fund, right? But the alpha generation has been not been so high. Given the given the differential which is low, the amount you are paying as a fees may not be an appropriate amount. It's slightly higher. So index you typically get at a 0.2%. Here in the direct case, you are paying around 1.44%, and here it is 1.95%. So if the delivery of return is something similar, right? So when you are saying ESG exclusion, ESG has been like it was on a high from 2014 to 2020, and it has worked more during the COVID time because everybody has become environmentally conscious. But will that outperformance continue because of the ESG? Again, that's a question an individual has to take into consideration. So this video is purely for an educational purpose only. The asset class in discussion is neither a recommendation to buy nor a sell. So even before investing, every investor has to do a due diligence, has to understand what this fund is about, and they have to understand what their desired asset allocation is, ideal asset allocation is. Probably you should sit with your advisor or a distributor and understand, then only invest. Thank you.